Welcome to Chapter 9 of Intermediate Accounting. This is all about inventory's additional issues. So there are some very challenging topics that we're going to cover in this chapter. So make sure that you watch all of the videos to get full coverage of everything that we are going to talk about. So first of all, we want to talk about the inventory valuation at the end of the accounting period. So these are some key things that you have to consider when it comes to evaluating how much your inventory is worth and how much it should show up as on the balance sheet. So obsolescence, here we're looking at any items that are sitting in inventory that are either outdated or just no longer sellable. So whether this is because like think about the computers from 20 years ago, and they're the big box computers. Like nobody wants those anymore unless they have some kind of old computer museum, right? Those are obsolete now. Maybe it's fidget spinners. So fidget spinners were really popular for a year or two, and now maybe you could still sell them for something, but they're not worth nearly as much as they were before. So things like that. Then there's theft and loss. So in reality, unfortunately, there are going to be these two things occur, and we have to make sure that we account for that as well. Physical damage, maybe there's a leak in the roof, maybe somebody spilled something on the inventory, maybe someone dropped a box. But physical damage is something that unfortunately is going to happen whenever you have inventory as well. Price declines. So maybe the value of your inventory has decreased over time. And then excess inventory. Large quantities of slow moving items can be an excess of inventory, and you may have to reevaluate how much that's worth. So inventory is just so tricky when it comes to how much should I have on hand. And the more you have on hand, the more you're going to see all of these things happening. So some of the things that we are going to use when it comes to valuing our inventory is it's going to be LCNRV. This is the lower of cost or net realizable value. So we're going to walk through what this is, walk through a problem, but most inventory is valued at the lower of the cost or what it could be sold for, the net realizable value. There's also market replacement cost. This is going to be used under LIFO and retail methods, which we're going to cover the retail inventory method in the next video of this chapter. It can also be quite tricky, so do not miss that video. So the method used is based on the inventory approach being practiced. So as I said, for LIFO or retail methods, we're going to use the market replacement cost. For the other methods, we're going to use that lower of cost or net realizable value. So let's jump into the lower of cost or net realizable value. So inventory must be reported at the lower of its original cost or what it could be sold for now, the net realizable value. So we're going to take, to get our net realizable value, the cost of completion, disposal, and transportation. So we take that inventory and say, okay, whatever we have to do to get it to the point where we could sell it, any costs that we have there, minus the estimated selling price, that gives us our net realizable value. The purpose of this is to avoid overstating inventory and income. As accountants, we want to be very conservative with our numbers, and that's what we're doing here. We want to show it at either the cost, or if it's not worth that anymore, we need to decrease it to the net realizable value. So we always want to show that conservative approach in all of our financial statements. We use this for companies that are using FIFO or weighted average. And if those are not ringing a bell, jump back to chapter 8 because that's where I cover all of that. So again, this is where there's price drops in the market or the inventory is damaged, outdated, obsolete. So this is where we're reevaluating how much is this inventory actually worth. If the net realizable value is lower than that cost that we originally paid for the inventory, the amount that we're reflecting on the balance sheet, a loss is recorded and inventory is written down. Written down meaning we're expensing that out and we're going to show inventory at the lower number. So our new case study is Urban Myth Outfitters. So legendary looks with everyday wear. So we've got all new things to look at. Okay, this is a lot, and there's going to be a lot of this kind of thing in this chapter. So Stick with me and we're going to get through this together. So Urban Myth Outfitters has 5 inventory items, and you're going to see these 5 items listed over and over again in all of these examples. So they have those on hand at the end of the year. The year-end cost, which is determined using FIFO, and the net realizable value, which we talked about what that calculation is, for each items are presented below. The first 2 items are a collection of similar items, while the final 3 items are another collection of similar items. So each selection there, each collection are going to be considered a category of inventory. So what that means, we've got Bigfoot Trail Hoodie and the Nessie Snapback, that's a hat, like for the Loch Ness Monster. Those 2 are going to be considered one category. Then, so that's the total for the first group. Then the next 3 items, the Area 51 cargo pants, the Mothman tote bag, and the Cryptid socks bundle, those 3 are another category. That's what the company's broken it down in, that they say those are a good category to include together. So what we do, just the numbers they've given us, we look at the cost compared to the net realizable value, and we're going to take the lower of the 2 to make sure our inventory is reflecting whichever is lower. There are 3 ways to do this. We can do it by individual item, we can do it by category, like we talked about those 2 different categories, or we can do it by all of the inventory. So let's break this out. We look at the Bigfoot hoodie, and we've got the cost was $45,000 for all the hoodies we've got, but the net realizable value is only $42,000, so the value's dropped. So if we're just doing by item, you see right here at this top line, by item, we've dropped it down to $42,000. The Nessie Snapback, it was lower when they bought it than what the net realizable value is, so the lower would be the cost. So if we did it individually, that's how we break it out. Or we can total the 2, and we say the cost for the first category was $67,000, the net realizable value is $68,000, and we just take the lower of those 2. So our category would be $67,000. So you could choose either of those, or we'll look at the total inventory. So then we do the same thing with the second category with these 3 items. Okay, the net realizable value is cheaper for the cargo pants, or is lower. The cost is lower for the tote bag, and the net realizable value is lower for the socks. So if we did by item, then we would say our inventory, it was the cost, it was $175, but we'd be writing it down to $167. But if we did it by category, then it would be $172. And if we did all of the inventory together, okay, so all the cost was $175, all of the net realizable value was $173. If we decided to do the total of all the inventory, which was lower, then the net realizable value was lower, so that would give us $173. So we get to choose. Do we want to use the by item, by category, or by inventory? Either way, regardless of which of the 3 we choose, the cost is not as low as these other options. So it's going to be written down, because right now on the balance sheet, we're showing the cost of $175. So we're going to either write it down to $167, $172, or $173. And you can choose which one of those. Of course, your homework's going to tell you which one to do. So by individual item, it was $173. So the cost of the 175 would be recorded to knock it down to $173. So back over here, I'm sorry, not the individual item, but total inventory was $173. If we're going to write it down to that, we need to write it down by $2,000. So we had it on the balance sheet at $175. We wrote it down by $2,000, and that brings it down to $173. So the journal entry to write this inventory down is to debit cost of goods sold, credit inventory. That brings our inventory to the number that we wanted it. The reason we're debiting cost of goods sold, even though we're like, wait, this was like damaged items or obsolete items, we didn't sell these items. Well, it's because part of the cost of doing business is, the fact that there's loss, theft, damage, and obsolescence. Those result in just the normal cost of doing business. So we reflect it in cost of goods sold. So that's how we write down the inventory to the lower of cost to net realizable value. Then we have the lower of cost or market. So these are the ones we use it for, LIFO or the retail inventory method. Again, we'll talk about that in the second video. But if you're using one of those methods for inventory, you're not going to use lower of cost or net realizable value. You use lower of cost or market. So let's look at what that means. So we are going to have, this one gets a little trickier. We have a ceiling and a floor. The ceiling is the net realizable value. So that comes into play again here. So the market should not be greater than the net realizable value. The market is the replacement cost. So then the floor, it should not go below the net realizable value minus the normal profit margin. So we're either going to use the cost or the market, but the market, which is the replacement cost, cannot go higher than the net realizable value. It cannot go lower than the net realizable value minus the normal profit margin. So it has to be, the top it could be is that net realizable value. The bottom it could be is the net realizable value minus the normal profit margin. Really confusing. I agree. So let's walk through an example so that you can see what we're talking about here. We've got our same 5 items, but we're not breaking them into category. We're just going to do them individually. So we have the selling price, and then we have the estimated selling cost. That brings us to the net realizable value. So we take the selling price minus the estimated selling cost. That gives us net realizable value, which is our ceiling. Then to get our floor, we multiply the net realizable value times the 20% of selling price, which is what they give us up here in the word problem. The normal profit margin is 20% of the selling price. So we take the selling price times the 20%, and that gives us our normal profit margin for the hoodie. For the selling price for the snapback hat, it's $120,000 times the 20%, it gives us $24,000. So we just do that for each one. The selling price times that normal profit margin, and that gives us the amount we're going to subtract out. So our floor is our net realizable value minus the normal profit margin we just calculated. That gives us our floor. So our ceiling for the hoodie is $80,000. Our floor is $60,000. For the snapback, it's $90,000 as the ceiling, and the floor is $66,000. In other words, it cannot, the lower of cost or market, the market cannot be above the ceiling or below the floor. So I'm going to use these same numbers, and we're going to jump into the next slide. If you want to take a picture, take a screenshot, now would be the time to do it as we jump into what the next slide is, and we take the ceiling and we take the floor from this slide onto the next one. All right. So some more information on this. We have got the cost. So we're now figured out what the cost was for each one. The replacement cost, which is the same as the market. And then we from the last slide, we took our ceiling and our floor. And what we are going to do now is for column E here, we want to figure out, is our market we've got the replacement cost was $55,000 for the hoodie. It can't go above the ceiling or below the floor. $55,000 is lower than the floor. So we just take the middle of that. We just take the floor. That's as low as it can go. So we take that $60,000, and that's what our market amount will be. So then we say, which was lower, the cost of $50,000 or the market of $60,000? Well, $50,000 is lower, so we're going to leave the hoodie at the $50,000 that it was reflected on the balance sheet. Then for our snapback, we paid $100,000 for all the inventory we have. A replacement cost will be $97,000. Then our ceiling was $90,000. We can't go above that, so we can't go all the way to $97,000. We can't go below the floor, so we're pretty much going to take the middle, which is $90,000, and that will be our market. Well, the market of 90 is lower than the cost, so we're going to use the 90 for the market. So we're really just taking the middle of these three numbers here, and that's what we use. So our cost for the cargo pants was $80,000. The replacement cost is $70,000. The $70,000 falls below the ceiling and the floor, so we pull the $70,000 over. And the $70,000 is lower than the cost, so we're going to use that. So we do that for each one. Really confusing, I know, but it has to be whichever number is the middle. Then we take the lower of cost or market we figured out for each of those four items, and that is what we want to write our inventory down to in this situation. So in this one, we were showing $415,000 as our cost on the balance sheet, but we need to write it down to the lower of cost or market, which totaled $392,000. So the difference between the two is $23,000. So we're going to write that down from the $415,000 that was on the balance sheet down to the $392,000 by making a journal entry for $23,000. And that would be a debit to cost of goods sold, a credit to inventory. All right. So we wrote that down to the lower of cost or market, and we did it per item. All right, last thing that I want to talk to you about is the gross profit method. And then the next video will be the retail inventory method. So the gross profit is a quick way to estimate ending inventory when a physical count isn't feasible. So after a fire, theft, or interim financial reporting, any of that works. We still want to do a physical count at least once a year, and many companies do it much more often than that. But we want to make sure that we have a method like this if we need it in a quick situation. It helps businesses make timely decisions and prepare financial statements without delaying a full inventory because of a full inventory count. So it does come in handy. It's definitely important to use this at certain times because we can't always do a physical count. And some companies, it doesn't take that long to do a physical count. Others, it can take weeks to do it. So it depends on if they have lots of locations and all kinds of different inventory. So the typical method that we would use would be take our beginning inventory from the records, then we add net purchases, and that's our goods available for sale. Then we subtract ending inventory, and that's our cost of goods sold. That's what we see especially in the periodic inventory. For the gross profit method, we're going to do the same thing, except it's going to be estimated. So we don't have the physical count. So they're going to they take the beginning inventory and the net purchases, just because we've been keeping track of it. So that gives us our goods available for sale, but our cost of goods sold and ending inventory have to be based on an estimate. So that's the big difference here. It's just going to include estimates. So if we see our example with Urban Myth Outfitters, they reported the following inventory activities. So they had beginning inventory and net purchases that totaled goods available for sale of $2.4 million. Then to figure out our cost of goods sold, they're going to say we had our net sales. They kept track of that. That's from our records. We've got $1,750,000 in net sales. Now here's where the estimations come in. They have to have estimated gross profit. They're saying it's 40% of our net sales. So we take 40% of 1.75 million. That gives us 700,000. Then we take our estimated cost of goods sold. Well, how do we get that? Well, if 40% is profit, then 60% is our cost of goods sold. So we take our 1,750,000 times 60%, the leftover amount, and that's our estimated cost of goods sold. So then to figure out our ending inventory, take our goods available for sale, the 2.4 million, minus the estimated cost of goods sold based on, typically our cost of goods sold are 60% of our net sales. And that gives us our ending inventory, that difference. So there's not going to be an exact amount, and there's going to be things come into play such as theft or obsolescence and all of that, but we're doing the best we can to get a quick number. So an accurate gross profit ratio is key here, because if you don't have any way to really have a true good estimate, then you're really going to struggle with getting a solid number here that has any accuracy to it. So the way you're going to do it is you're going to look at the history of the company, how much does it usually, how much is the profit, how much is cost of goods sold, and get a good stable number. Otherwise, this is not going to be a very accurate picture. So the gross profit method has to do all with estimates, and we want to make sure we have a really good way of figuring out what that estimate would be. All right, I'm going to end this video here. We've covered a lot already. Make sure you watch the following videos. This is not a very long chapter, but I feel like the content is pretty tricky. So make sure that you stay tuned for the rest of those.